Real Estate and Retirement Video Part 2. This is the two-part series covering the subjects of real estate and wealth. Let's get this started. There is another issue with owning property in California that many don't think about: the risk of having all your eggs in one basket. Please allow me to explain. If you have 132 that you buy for $1.5 million in San Francisco Bay Area, that's one investment. That's one rent collection per month. That's one front door. If one of your renters stops making payments, you lost 100% of your income. On the other hand, if you buy property like, say, in Missouri, a huge 3-2 in comparison to the California property, it will cost you less than $100,000 each. Or in other words, you can own 15 properties for the same $1.5 million. Now, if 2 of your tenants stop paying in Missouri, or even 5 of them stop, you're still collecting on the other 13 to 10 doors respectively. The one door in California will bring in around $4,000 monthly. But let's give the market the benefit of the doubt and say it brings in $5,000 monthly. Each of those properties in Missouri will conservatively bring in $1,000 each, after all expenses, but closer actually to $1,200 per month. That's $15,000 to $18,000 a month. Which investment sounds better and less risky to you? If you meet with a real estate investor who flips houses, they'll understand what a hard and private money lender is. There is the family bank concept that I speak on in a previous video on here. The Index Universal Life Investment, or IUL for short, has amazing benefits that I don't have time to cover here in this video and must be qualified for, but it's worth seeing if you do. One of the advantages of the IUL is you can borrow against it depending on the IUL at 0.24%, and if you pay it back before the end of the year, that's 0%. It's like a HELOC, but without the annual fees and much higher interest rate. Or put another way, it's like having $500,000 liquid cash in the bank account, and maybe in a CD growing at a sad 1% interest, maybe, to buy and fix up a property, and even while that money is out of the account and is used to work on your flip, or if you're a lender on other investors' fix and flips, the original $500,000 is still growing in that interest growth account as if it was never touched. If something goes wrong and you can't pay the loan back, instead of the bank foreclosing on your project, that amount you borrowed would then be deducted from the life insurance policy portion of the policy. No foreclosures. However, it would also mean that you have much less capital that you can borrow if you need to from the said IUL in the future until you return the borrowed amount back into it. I don't have a crystal ball, but it's my opinion that in San Francisco Bay Area that we will see a drop in real estate prices sometime in quarter 3 or 4 of 2022. The moratorium on forbearance mortgages ended in September of 2021, and those who couldn't pay their loans off before most likely couldn't just begin to do so now that the moratorium ended magically. It'll take 6 to 8 months conservatively for banks to foreclose on those properties. By the basic rule of economics in regards to supply and demand, this means we have a lot of properties flooding the real estate market. That would make the average cost of homes in these markets drop considerably. Also, the low cost to borrow money right now is also overinflating the real estate market. If the interest rates on the refinancing and new mortgage go up, you will see property prices fall there as well. When money costs more to borrow and access, it affects everyone's monthly budget and bottom line. Markets with already reasonably priced homes will feel less of an impact. I think of properties in Silicon Valley, California, like a Louis Vuitton bag. The properties are way too expensive if compared to the price of the material alone. Yes, in real estate, it's all about location, 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 but compare a home in Florida with low taxes and no state taxes. A 3-2 there is under $200,000, and the same exact property around these parts is around $1.5 million. It's just gone too far at this point, and like the S&P 500 since 2008, it's bound to correct at some time. Again, these are my opinions. I can go on and on about real estate, and I do cover a lot of what I said here and more on my website blogs at healthwealthandrealestate.com, and the blogs are just text versions of my YouTube channel. I cover the subjects I am most passionate about: health and how I beat type 2 diabetes and no longer take insulin or pills, and wealth. I cover all kinds of subjects that are specific to my license as a financial professional, like the family bank I mentioned here today. Another of the 3 ways schools have failed us, which has the lack of financial education in there. Did you know that 7.5 billion people in the world, only 3% are considered financially literate, meaning 5 billion people need my help? And that means in the US alone, there are 330 million people, so 231 million people need this information. Finally, the last subject is on real estate, where I cover 13 terms every real estate investor should know, 13 risks of owning real estate rental properties, 4 reasons I'll never invest in California, and more. I keep all my videos short, packed full of information. I hope you find them useful. I have a Calendly link on the comment section below for one-on-one customized training based on your level of financial literacy, and I put together a plan based on your needs and wants for your future. Ask yourself these 5 questions. At what age would you like to retire? How much would you like to have saved up for when you retire? How much income do you need to live on for the rest of your life in retirement? What are some of the big goals and dreams in retirement? If I can put a plan together for you that would put your family in a better financial position and create this plan for you at no cost, is there any reason why you wouldn't move forward? I get asked by financial advisors who don't all get these concepts or have never heard of them. How do I make any money doing this for free? Am I doing this out of the goodness of my heart? The typical financial advisor doesn't like doing these deals because they can't collect annual income for managing your money. The financial advisor also can charge up to $2,500 to do these investment plans before you put a penny into whatever plan they've come up with. And they put you in variable-based accounts that have risks in losing your hard-earned money. Warren Buffett said, Rule 1 is never to lose money. Rule 2 is to refer back to rule number 1. I like to share the great upside as well as the downside on a particular investment, and if I can't answer your questions, I have agents with 20 plus years of experience in my office to fall back on, and CPAs on staff as well, but I always recommend using your own as they know you best. I believe people need to know all their options in order to make an educated decision, to make the best choice for them specifically, and I believe in sharing the pros and cons of each investment option. Thanks for watching. And please feel free to comment below or send me a message from the healthwealthandrealestate.com website on the Get in Touch link on the top of the webpage, where there's also a calendar link to customize a lesson for you there. And in the comments section here below. Please like this video and subscribe to this channel so you don't miss any future content. I also would appreciate it if you shared my videos with friends and family, as I love helping everyone and I want to get to as many people as I can. I look forward to speaking with you soon. Have the best week. Spread joy and happiness. Let's make the world a better place, one person at a time.